prices edge higher. Mortgage rates, of course, are at record lows, but sales are still weak. So where exactly are we in the housing recovery? Well, joining us now is Paul Ballew, chief economist at Nationwide, and Adam Leitman Bailey. He is a real estate attorney, also the author of The Uncommon Deal. Adam, is it fair to say we cannot look at the real estate market as one market? You're saying there are actually three out there. What are they? And are any of them seeing a decent recovery?
Well, yes, there's three markets. First, the very rich. Those who do not need loans are king. We're seeing bidding wars and record pricing for those people that do not need loans to buy homes. So the above 5 million market or above 4 million market in major cities is doing incredible. And there's already a recovery. Then the second market is not doing so well. Loans are harder to get. They're more expensive. On October 1st, the jumbo loan goes down to $625,000. That means that buyers have less money to go shopping with, and they're not going to be able to buy the same prices. Sellers are going to be selling for less. Cash is going to be king. Then the third market is where it's really bad, foreclosures. For some reason, we still can't get them out of the system. The courts are holding them up. The government is not pushing them through, and that market is just going to be eventually flooding homes into the market, and that's going to take prices really down to a low level. I see this as a huge problem lasting at least another 5 years.
Paul Ballew, react to what Adam just said, specifically to that falling loan limit for federally backed mortgages and what that might do to the big middle bracket of housing in lots of metro areas in this country. Does it put a cap on it?
Well, it adds another complicating factor into this process we're going through. Housing's probably not going to hit bottom until 2012, maybe 2013. We're starting to see at least the rate of decline ebb, but that's just one of the set of factors we're still going to have to deal with. The questions around foreclosures, different regulatory standards, and certainly requirements of banks, and then the overall economic backdrop with the slow recovery. So maybe some signs in some pockets around the country of stability, but certainly not signs of growth at this point.
So Paul, you're saying it's going to take another 2 years before we hit bottom. But what do you think about Adam's point a moment ago that the section of underwater America, the foreclosures and such, is going to take 5 years?
Well, I think as we look at housing, we shouldn't be banking on housing providing a positive stimulus to the economy until the middle part of the decade or maybe beyond that. So we're looking for stability as we get out in the next couple of years, but we're not looking at growth. And it's just because of the massive level of overhang we have to deal with, plus the other variables that are out there, including changes in the regulatory environment. So you put it all together, we're living through a very strange recovery because housing is a drag on this recovery. We've never gone through that before, but we've never had a bubble of this size that we've had to digest. So I would be prepared for housing to continue to be a drag, probably a secondary drop in 12 and 13, hopefully some stability beyond that, and then as we get out to the second half, maybe some growth.
Adam, very quickly, I want to say ever, but for the next generation, will housing potentially be the wealth builder it was for this generation, or not at all?
I think that homeowners' greatest investment and the way they can retire on money being housing is a dinosaur. I think we're going to have to understand that we may not have appreciation or equity in our homes for the next 30 years. And that's a really big statement I'm making, and I know that. But so many people are underwater that they may not be able to recover unless they have cash.
What has happened to the American dream?
Yeah, gentlemen, thank you very much. Yeah, depressingly, thank you very much.